Do you have enough stocks in your portfolio? Imagine if one decision could determine about 90% of your rate of return as an investor. Sounds important, right? Aside from your savings habits and sticking to a long-term plan, your asset allocation, which is the mix of stocks to other asset classes in your portfolio, is one of the most significant financial decisions you will ever make. In fact, there is Nobel Prize winning research that suggests approximately 90% of your lifetime rate of return comes down to the percentage of stocks in your portfolio. So why are we leaving, in a lot of cases, this crucial decision up to some things as simple as a 1 to 10 risk tolerance questionnaire? While risk tolerance certainly matters, it's important to consider all of the relevant pros and cons in different courses of action. So that's what we'll address today. We're going to dig into some of the data, reconsider some assumptions about stocks, bonds, and risk, and we will be discussing what this data means in the context of a retirement plan and generating retirement income. So stick around. Let's dive in. One of the biggest misconceptions about investing is not considering different types of asset classes in net of inflation terms or real returns. Oftentimes the comparisons between stocks and bonds are framed in nominal terms, that is without accounting for inflation, and they do not consider the significance of time. Inflation is a silent force that erodes purchasing power over time, and it has a much greater impact on bonds. It's not just about how much dollars you have, it's about how much purchasing power you have and what you can trade for your investments. Here's the reality. Over the past 100 years, inflation has reduced annual returns of stocks and bonds by approximately 3% per year. That brings the long-term average of inflation-adjusted return for stocks to about 7%, and for bonds it's about 3%. So when you factor for inflation, the stocks accumulated significantly greater purchasing power at over 2 times the rate of real return over long periods compared to bonds. This difference is significant, and it underscores why understanding real returns is critical to making portfolio decisions and building wealth. But don't bonds offer protection in the short term? Well, that may be, and let's talk about risk. Specifically, the potential for short-term declines. Many people define risk as what would be the worst potential outcome over a given time period. And while technically any investment could go to zero, and past performance is certainly no guarantee of future results, this historic data provides some valuable insights into the probable behavioral tendency of certain asset classes. For example, as you can see in this chart, the real returns after factoring inflation over a 1 to 2 year period of time, the bonds do offer significantly better worst case scenarios compared to stocks. In that 1 year scenario, the downside is roughly half of what the downside could be in stocks. But as we extend the time frame to 5 years, we can see how the story changes. The worst case scenario for stocks in that 5-year time frame is negative 12%, compared to the worst case scenario for bonds in that 5-year time period is negative 10%. So it's really not acting as a very significant buffer in that worst case scenario when we compare over longer time horizons. And it's also important to consider in this 5-year scenario, you're getting a little bit of a buffer in bonds, but the potential upside in stocks, particularly over this 5-year period, is over 10% greater than in bonds. So investors would be wise to consider this data, especially if they're thinking about investing for over 5 years, as the risks may potentially outweigh the returns comparing stocks to bonds. But what if you're nearing retirement? Should you still hold stocks if you need to start selling your investments? Well, the short answer is that it may make sense, although the allocation will vary depending on personal circumstances and goals. The short-term diversification of conservative investments like bonds, and maybe more importantly, money markets or CDs, can provide a buffer against sharp market declines, particularly in the years right before and right after you retire. This is known as the risk zone of retirement. Even so, holding a significant portion of your portfolio in equities can still be a sensible approach that could significantly impact your portfolio's longevity. According to this chart, you can see how portfolio risk of failure changes depending on the allocation of stocks to bonds at different withdrawal rates. At a 4% withdrawal rate, the research shows that portfolios with 55% equity often have the lowest probability of running out of money in that 30-year time period. That said, it's not always about minimizing risk at all costs. For example, a portfolio with 70% equity might have slightly higher chance of failure at a few percentage points higher, but offers the potential for 1.5 times greater median wealth by the end of the plan. This could mean a significant potential difference that could equate to maybe 6 figures of potential wealth impact at the end of the plan. So if leaving a legacy or building long-term wealth is important, then it may be a trade-off worth considering. It's also essential to consider that the future of bonds may look very different than the past. Over the last 30 years, which is what we're looking at in this data, bonds benefited from steadily falling interest rates, which provided for capital appreciation that boosted the returns of bonds on top of the normal interest payments. But today, with interest rates more likely to remain stable or even potentially rise, it's unlikely that bonds will deliver the same returns that they have historically. This raises an important question. Should we revisit the role of bonds in the portfolio? If we reevaluate, it may make sense to have a higher percentage of equities than we would have historically. Or for investors that prefer to maintain a cautious stance, it may mean incorporating different alternative conservative type investment strategies in their portfolio to complement some of their bonds. This could mean private credit or buffered ETFs. Private credit is basically investment that's similar to a bond in that you're loaning out your money to a company, but it's to a privately held company. And these may have potentially higher fees, but also potentially higher returns and different risk profiles compared to traditional bonds. Buffered ETFs, on the other hand, allow for investors to participate in some of the gains up to a certain cap while having some downside protection in the market, which can offer potentially a smoother ride and mitigation of some of the market risks. These options could be valuable to consider, especially for investors looking to add some stability relative to their equity portfolio going forward. I hope this video gave you a fresh perspective on asset allocation and the importance of stocks in a portfolio, especially for a retirement income plan. If you found this video helpful, please subscribe to our channel for more insightful financial content. And if you're planning for retirement or you're wondering whether your portfolio is truly working for you as best as it could be, please contact us at www.parkmountfinancial.com or reach out directly. We'd love to help you create a strategy tailored to your goals. Until next time.